G'day everyone and welcome back to this Share Cafe Hidden Gems webinar. Thank you for your Friday lunchtime time. Today we will discuss marketing and customer experience, battery technology, potash, medical imaging and data management. Don't forget to ask questions. Type your questions in the box provided. The CEOs always look forward to them and they'll answer them when available. Now we're going to make a start straight away. First up, we've got South Harz Potash, ASX code SHP, market cap around $37 million. We have with us Ian Farmer, who's coming to us from the UK. It's about 3 o'clock in the morning over there. Ian is, of course, the acting executive chairman. The company specialises in the development of potash mining projects. Ian, good morning. Over to you. Thank you.
Good morning. It's a pleasure to introduce South Harz Potash this morning to you. If you can move to slide 3, please. South Harz Potash is a company with assets of significant scale in central Germany. 5.3 billion tonnes of mineral resources is huge. We cover an area of 659 square kilometres. And we have 3 perpetual mining licenses, which are quite unique. They have no time restraints or royalty requirements. And we have 2 regular exploration licenses. The approach we intend to take to exploit our properties is fairly simple and fairly straightforward. It's not complicated at all. And we're supplying into a growing market, and in Europe there is a deficit of supply over demand which we can exploit. Germany itself is a highly attractive location, and I'll talk to that through the presentation. Moving on to slide 4, please. This is a map of the South Harz region where we operate. The dark green dotted line represents the potash basin, and you can see the land holding we have highlighted here in the various colours is fairly dominant in the area. The grey areas to the north are the old mined out areas that were mined during the East German period over some 100 years. In the very top right hand corner you can see the Ongo area, and top left hand corner, that is the siting of our first project. You can see it's the smallest of our properties, but in some ways the most prospective and easiest to develop. Moving on, please, to slide number 7. The markets themselves are in a very interesting position. The underlying thesis has always been that potash demand will increase as the world's population increases, as the world's diet improves, and as finite arable land becomes exhausted, requiring additional yield from crops. That's all still true, but of course it's been dramatically affected by the geopolitics of the last few months, with conflict in Europe, and purchasers of the commodity are looking at the strategic nature of potash in the food security debate. And that's, I think, causing a structural shift in the price upwards that's not going to reverse in the short term. So you can see historically the price has sort of hovered around the $200 to $300 level. I think that history, if you like, is going to be reset going forwards to our advantage. Moving on to the next slide, please. The Ongo project is the first of our projects. It is a down dip of the old mines, as I mentioned earlier. It is also on the silverite horizon, which is the preferred ore, and it is the first taxi out the ranks, so to speak, in terms of exploiting the large land position we have in the area. The highlights of the Ongo project are, of course, that it has a low carbon footprint. It'll be an underground mine with very little on surface. And we can come to the environmental credentials on a later slide. It's in an area with a strong potash mining history, which is important to us, and these rights are perpetual with no royalties thereon. So that makes them financially very attractive as well. It's a shallow deposit, thick, simple, well understood mineralogy, been mined for many years. Moving on, please, to the next slide. We've numbered the different projects here on that map, and the Ongo project is the first taxi out the rank, as I mentioned earlier. We have some 300 boreholes across those properties that we inherited with the mineral rights when we acquired them. And you can see the Ongo property in the bottom left-hand corner is actually the smallest of the properties. And you can see the size of the others by comparison. So we're starting out with the smallest and most prospective, but it's by no means the cream of the crop. There is more to come in the future. Moving on, please. When we acquired the mineral rights, we inherited some 300 borehole results with the properties. And to put that in context, each one of these holes costs about 2.5 to 3 million euros to replace. So it's a fairly important inheritance in terms of financial value. We did not, however, have the core from those boreholes. And to get a competent person to upgrade the inferred resource to indicated, we needed to do some parallel drilling, some confirmatory drilling. We've done that during the first part of this year, and some 89% of the silverite seam at Ongo has been upgraded to indicated as a result of drilling just 2 holes. So you can see that the leverage, if you like, from being able to do small amounts of drilling to extrapolate those results to the other holes, it gives us a significant uplift in geological data for very little investment, effectively. And that, I think, was good value for money. Moving on, please. So the Ongo project itself, the physical outcomes from it are that we are planning in our scoping study to mine 1 million tons per month of potash. That comes from 4 hoisted ore, and also gives us 2 million tons of salt, 1 million tons of which is saleable. It gives us a 21-year mine life with a 3.6-year payback. And down the right-hand side of the page, you can see some of the salient physical attributes of the property. About 60% of the product will be granular, 40% will be standard grade MOP, as they call it, and we'll probably sell about 75% into the European market, with 25% going to exports during the off-season. Moving on, please. So, as we evaluate this first project, we have completed the initial scoping study work to high standard. It's based on what we believe are realistic and sensible assumptions, and it shows a fairly compelling financial outcome, which I'll come to on a later slide. The funding of the project is something that obviously now is available, and this study gives us the first hard data to enable us to go and discuss with various strategic investors and with potential funding partners how the project might be funded going forward. Included in that, of course, is the possibility of an AIM listing at some point in the future. Royalty streams and offtake contracts and all those things are fully available to the company to finance the project going forward. So we have a complete array of options in terms of how the project is funded in the long term. As regards the development itself, it's all pretty straightforward. We believe we can fast track the development and complete it in 2 years post permitting, again, which I'll come back to. Moving on, please. Financial results of the scoping study were fairly robust at a potash price of $385 per tonne, which compares to the current spot price of around $850 a tonne. And we're coming out with a net present value of around just less than $1.3 billion. And an IRR of 26%. So a fairly sort of compelling set of financial outcomes. The cash operating cost of the project comes out net of byproduct credits at around $93 a tonne, and that's fairly near the bottom end of the cost curve. The cost of the project build is $620 million, which is not insubstantial, but by potash standards, it's actually extremely competitive. We did run the net present value, obviously, at a range of other numbers. And the net present value at the spot price at the time the scoping study was released of $900 per tonne came out at 4.2 billion, so pretty high numbers. There is an alternative case that we are evaluating where we actually build the mine in 2 500 million tonne slugs rather than going for the 1 million tonne in one go, and that comes out with a peak financing of $443 million. So there is a way to moderate the capital requirement if necessary. Moving on, please. Being based in Germany, of course, the environmental focus is paramount, and the obligations that we are going to have to comply with are extremely strict. There are 2 undertakings we've given, which are really important to understand. One is that we will develop this mine with no permanent waste piles on surface, And the second obligation we have is that there will be no industrial water discharges into groundwater and into rivers, etc. We are able to give those promises because of the mining and processing approach we have selected. Mining will be through room and pillar approach and on take-out pillars and substitute that with backfill. And that'll mean that all the waste we produce on service can go back underground. In terms of water discharges, the processing approach we've taken there does not produce large volumes of brine. It enables us to, it's a leaching process followed by a crystallization process, which is not water-based specifically. Therefore, any brine that is produced can go back underground with the waste stockpiles. So there'll be no tailings on surface and all that sort of thing. So those two undertakings are extremely important in terms of permitting. We specifically designed the approach to exploiting these assets on the basis that we can meet those two obligations. Moving on, please, to the next slide. As you will expect, the social commitments in any area are of paramount importance, but they're particularly important to us in the South Harz area of Germany. As I mentioned earlier, mining has taken place in this region for some 100 years, and the mines that were there on reunification in Germany were largely underinvested and overmanned and not economic at that time, and were closed by the combined new German government. That created some resentment and some pushback by the local inhabitants in the South Harz region, and indeed there were strikes and there were hunger strikes and protests and such like at the time. And the local population felt very strongly that the mines themselves did have a future and should be invested in, and that there was plenty of potash to be mined. But at the time that the new German government of the combined West decided not to go down that route. So there was a lot of resentment, if you like, at the time from the local population as regards the decisions that were taken. So as we look to revitalise mining in the area, we need to be conscious of that history. And we found that there is generally a fertile ground for conversations around reactivating mining, because it gives the locals a chance to say, we told you so, look, there's now a foreign company that can do what we told you could be done all those years ago. So that there is a good level of support for mining in the area generally. And there are lots of people that have mining in the history of their families in the area. Moving on, please. So the all-important delivery pathway. This is basically the next 5 years and the work we have cut out in front of us. The first step is to finalise the site selection and to complete the pre-feasibility study, which will take us around 18 months. In parallel with that, we'll complete the environmental study that's required to inform the full feasibility study, which is detailed on the next line, which will take us 2.5 years to complete. Those work streams have been designed and dovetailed to the permitting process, which we can commence in 6 months' time and takes in total about 2.5 years. It's done in stages. The first stage is to approve the site. The second stage is to approve the mine operating plan. And effectively, at the end of that 2.5 year period, you get your permission to go ahead and build the mine, which gives us the last line on the chart, which means we can start building around the back end of financial year 2025, and it's a 2-year build process. So it's a fairly straightforward program of work, and we're already enthusiastically engaged upon that. Next slide, please. So last but not least, we just want to draw attention to the series of taxis that may come out the rank over future years. This is obviously a long-term prognosis. The Ongo project itself has already been initiated. It's got an 18-month PFS process, which has been approved by the board. We will explore synergies with our neighbours in the region, which may improve the prospects of the study itself. And we're in the process of building our team so that we have the capacity to deliver. But thereafter, there are future projects which, over a passage of time and leveraging the 300 boreholes of data we already have, can be a key differentiating factor in showing us as a company that has several projects, and we're not a one-trick pony. And we can develop those assets into the growing market as the deficit of supply and demand in Europe increases going forward. Thank you very much.
Thanks, Ian. Bang on time, and thank you for your time. Now, a couple of questions here. Murate of potash, MOP, which is what you're producing, does it compete with sulfated potash? And obviously, sulfated potash doesn't contain chloride or salt. So how do you see them sitting together in what's obviously a very big market, given BHP has entered into this market in a major way as well?
SOP is a very small market compared to MOP. In rough numbers, the MOP market is about 70 million tons globally, whereas SOP is only 7. So MOP is a large global deep marketplace that's globally traded, so it's a much better place to be from a marketing point of view. MOP is simpler to produce. It doesn't have the technical complications that SOP has. Both the extraction and the processing thereof is all tried and tested and doesn't have any complications in terms of process type. And MOP is used primarily on things like wheat, corn, soybeans, the sort of major large cereal crops, which is why it's such a big and deep market. Whereas SOP is used more in sort of niche products like certain exotic fruits, tobacco, that kind of thing. So MOP is definitely the place to be because it's simpler, it's a bigger market, it's global, and indeed it's more widely used.
And given the geopolitical risks which have supported the MOP price, but obviously in somewhere like Germany, the power prices are through the roof. You've got droughts impacting water supply and power generations as well. Have you kind of modelled the rising energy costs into your scenario?
Yes, that was quite a difficult decision to take. The scoping study, as released, obviously contains energy prices in there. The prices we used were driven by long-term futures energy prices in Europe as quoted at the time, so they were sensible. There were some 30% above historical averages, but of course the issue in Europe right now is at crisis levels, and predicting what prices will be 5 years out is extremely difficult. So we have allowed funds in the PFS stage of our study to do a complete review of sources of energy. Obviously, the environmental impact of energy choices is something we want to look at very closely as well. So we've taken a sensible approach to the number we used in the long-term model, but clearly it is one of the factors that is a bit up in the air right now, quite frankly. And I think it's going to take a few years before that issue settles down and you can make better informed decisions than we can at the moment.
And just finally and quickly, in regards to CapEx, what sort of numbers are we talking, and what does a strategic partner look like, or an offtake partner?
The capital for the first of our projects is estimated to be $620 million. That includes $95 million of contingency. These are US dollars. That, by comparison to sort of industrial norms, is about 60% or so of what you would expect on a global average potash project. And the reason it's comparatively low is that we don't require any infrastructure really for this project, because we have road, rail, water, and power, as you've already mentioned, on our doorstep already, because this is an area that historically has produced for many years. So it's capital-wise extremely efficient versus industry averages, but nevertheless it's quite a chunky number for a small company like ours. As regards strategic investors, we have an open shareholder register. We have no commitments in terms of any offtake royalties or any other such instruments. So we have the full array of possible financing options ahead of us. And as I mentioned earlier, now that we have some hard data from the scoping study, we can explore those options, and we'll do that over the next 2.5 year period. Ideally for us, a strategic partner would be a financially interested party that's prepared to come in at the ground floor while our share price is very low. And of course, as we add some granularity and detail to our project study, and we take it from scoping study through to PFS, to DFS, etc., there's a lot of prospects of increases in share multiple significant. So finding a financial partner, if you like, that's prepared to join us on that journey and to fund its corner, if you like, for the fundraise over the sort of 18 months to 2.5 years will be very important.
Ian, thanks for your time. Just got a couple of internet issues at the end, but thank you for your time. We'll follow the story with interest. Have a nice weekend.
Thank you very much.
Okay, next up, we've got Mach 7 Technologies, ASX code M7T, market cap around $153 million. We have with us Mike Lampron, who's the company's CEO. Mach 7 Technologies, medical imaging and data management solutions are leveraged by global healthcare enterprises. There's a mouthful. Thank you for your time. Over to you, Mike.
Yes, thank you very much, and thanks everyone for attending this briefing. If we could move on to the first slide, please. Just a quick snapshot from this morning pre-market. Again, just 64 cents at the morning, 239 million shares at issue. From a substantial shareholder perspective, I highlighted three of our major institutional shareholders: JM Financial, Oz Ethical, and Climb Asset, representing the three largest shareholders from an institutional perspective. Next slide, please. So Mach 7 is in the business of medical imaging, and specifically enterprise imaging. I put a definition to the right here for those of you who may not be familiar with the industry, but enterprise imaging is really the collective imaging that's done throughout a hospital enterprise. That could be from radiology, it could be from cardiology, it could be from dermatology or wound care, it could be JPEG images or DICOM images or videos or MPEGs. Those can all be considered images. What Mach 7 has done is we've developed software across our solution to store, organize, and display that data in a connected way across a hospital network, which will allow clinicians easy access to all of those images that are coming in from disparate systems. The idea of our product is to not just replace current infrastructure. A lot of companies have made big investments in their current healthcare IT stack. We're there to either work with existing IT stack or to replace if it's antiquated and needs replacement. But above all else, what we're really trying to do, we're trying to fill those connectivity gaps to give a good connected patient record to the clinicians. We want to eliminate IT complexity, and again, making sure the clinicians have the best healthcare information available. Next slide, please. So specifically, our three products, it starts with enterprise data management. And for enterprise data management, the specific product we have is called the Vendor Neutral Archive. And that is an archive which is the central storage for imaging. It stores all of this patient data in all the image captures. We index it, we manage it, we store it, and we also distribute it back out to the clinicians in a meaningful way. Viewing and exchanging and analyzing that clinical information is a really powerful part of our platform. On the viewing side of the equation, when we're serving that data back out to clinicians for them to use effectively, we have got this eUnity zero footprint diagnostic viewer. Zero footprint meaning there's no software to install. It's an HTML5 with zero software to install. So from an IT perspective, you don't have to worry about an executable going on an iPad or another device. There's nothing the IT team needs to do per device. So that gives these enterprise users quick and easy access. This is typically done through an integration, oftentimes with the electronic medical record. The electronic medical record will be integrated to our viewing software. They will launch that viewer, which will automatically launch images that are being stored within the VNA. The last component is departmental workflow solutions. We have a universal work list with quality control tools to help the technologist curate those images prior to the radiologist reading them or prior to them being committed to the patient record. A powerful part of this platform, though, is the interoperability components. It's the third-party solutions. Every hospital needs third parties. We can't do it all. No one can. So we wanted to build a solution where we could easily integrate so that when people brought in new AI algorithms that they wanted to integrate with or other third-party solutions, image exchange solutions, they could easily integrate those into our VNA and take advantage of those things that they thought were important to them. Next slide, please. This just gives you a quick snapshot of the market. I think the important component of this slide really is to understand that our target market runs the gamut from integrated delivery networks to imaging centers, from medical research facilities to life science companies like Boston Scientific to telehealth service providers, academic institutions to regional hospitals. It runs the gamut depending on what part or how much of the solution a client needs to fix their specific issues around imaging and image management. Next slide, please. We're serving hospital systems around the world. We have 150 customers across 15 countries currently. Next slide. This just gives you a snapshot of some of our partners. Our partners represent about 8% of our sales orders in FY22. We currently have 27 partnerships for various things. Some of them reselling our products. Some of them are our clients. Some of them are resellers. It kind of runs the gamut there, but some great names in here. Saote is out of Italy. They're a cardiology solution. In Touch Health is a telehealth company. Lucid Health has a work list that they use. Nuance owns about 80% of the transcription market in the US. So some great names in here. Next slide, please. A couple key components just to understand sort of the relevancy of our product and whether or not it's resonating with the customer base. KLAS is sort of the consumer reports of medical software. They come up with what they call a best in class in every February of every year. This past February, for the Universal Viewer platform, Mach 7 came in ranked number 2, and for the VNA, we were ranked number 3. This is really the first time we've been listed in the KLAS rankings, so this is a great accomplishment for us, and it sort of just shows those of you who aren't familiar with all the software that this software is resonating with the customer base. It's getting great reviews, and we've got some really happy customers here. Next slide. I'll go through this really quick from a value prop position. You know, we try to go into a customer site and find a solution that fits for them. It's not just a in a box solution. We will customize the solution to make it work for the hospital and what their primary needs are at the moment. We want to solve immediate needs, and then we'll go from there. We're definitely designed for the enterprise, so we're there for the long haul with those clients. We want to provide flexible workflows. We want to have a partnership with our clients, not just a vendor-client relationship. Our technology will be lasting technology, cutting-edge technology. Our clients have the comfort of us being a global company with a growing cash position, and we offer flexible contract terms, meaning we will sell our software both from a subscription perspective, from an operating model perspective, or we'll sell it from a capital perspective. Some clients from a budget perspective need one or the other. We don't mandate that. We'll work with our customers to find the right contract terms that'll work for them. Next slide, please. So just some highlights for the year. This is FY22. We had record sales orders for the second year in a row of 33.2 million. Record revenue this year of 27.1 million. Contracted annual recurring revenue. So contracted annual recurring revenue would be either a client that hasn't gone live yet, so we're not yet receiving the revenue for a subscription deal, as an example, or if it was a capital software license and they haven't got live yet, we're not receiving the revenue for the support and maintenance agreements in years 2 through 5. So contracted just gives you an idea of what's sort of in the deferred revenue kind of line. From an annual recurring revenue, that $14.4 million run rate, if we take a snapshot of the June financials and we look at June across 12 months, that gets us to 14.4 million. We had some great contract wins this year. We had record EBITDA at 2.8, good cash inflow of 6.3 million this year, giving us a strong financial position of 25.7 million in cash and no debt. Next slide. From an outlook perspective, business as usual for the hospitals. This is kind of a post-COVID world now, and things are starting to open up again in the hospital space. Things are getting back towards a normal buying cycle. The customers, however, are prioritizing where they spend money. They know that they need the ability for their clinicians to work outside of the walls of the hospital now. And so they're putting in place the technology like Mach 7's technology so that those clinicians can be enabled to do that. We highlighted the KLAS rankings, award-winning products that are getting great recognition and strong interest across the industry. And we've got a great sales pipeline growing tremendously just in the last few months. and we have more than 3 times coverage for our goals for FY23 sales orders of 36 million. I believe.
Thank you, Mike. We've sorry to interrupt. We've got a few questions here if you've got time. There's a question around the average contract size, and we believe you've made some changes recently to your sales team. Can you talk through your sales process and what a contract looks like?
Sure. So from the sales team's perspective, yes, we do have a new leader on the sales team, Dave Madaffrey. He came in July of 21, so he's been here just over 12 months now. Along with him came a whole new sales organization. About 80% of our sales organization was replaced through September of 21, so they've all been here just about 1 year now, having great luck and doing a great job, both with the great sales orders that we received last year and the funnel coverage we have for this year. They've done a wonderful job. From the perspective of the contract size, unfortunately, it varies. It depends on whether we're selling to an IDN or whether we're selling to an imaging center. I think the largest contract we've signed was around 18 million, and it could go all the way down to 50,000. So it's really, there's a big gap there. It's difficult for me to give you a statistic on that.
Sure, no, that's a good range. And from a partnership perspective, you spoke about your partners being, I think they're responsible for around 8% of your sales. Is that a channel you plan on expanding?
Yeah, I think that channel can double in contribution. Maybe not double in number of partners, but with the right partners, it can double in contribution. We did hire just recently in January a new partnership manager to come in and help sort of grow that segment of our business.
A question here on the retention rate in terms of your contracts.
Really high retention rate. It's sticky. I think that our FY22 numbers were, it was less than 2% of our clients left.
And what's the sort of market size you're competing in? And there's also a question here around competitors and your competitive advantage.
Yeah, so it's a little difficult to give a total addressable market. I did have a world market in there. I think it stood a little around 2.5 billion or so. I would say that that's a market for medical imaging in general. But that's about as granular as I can get from a TAM perspective, anyways. What was the second part of that question?
Just where you sit in terms of competitors and your competitive advantage.
Sure. Well, certainly our advantage is that we are an independent company. When you buy Mach 7, you can buy our whole solution. You can buy a component of our solution that you need, but you're not necessarily going to have to buy into a whole ecosystem. Where some of our larger competitors, the GEs of the world and the Siemens and the Philips and the Agfas of the world, you really have to take advantage of their entire system and buy into their whole ecosystem to take advantage of maybe the one thing you really needed. For Mach 7, you can do it as it's required and we'll grow with you. You don't need to buy the whole ecosystem at once. So it's more of a best of breed solution.
And what are the kind of milestones that could play out towards the end of the year, Mike?
From a financial perspective,
yeah,
we've got some great coverage by Morgans and by Shaw and Partners, who put out some great information on that for everyone. But as we look into FY23, we're looking at around 20% growth from a sales order perspective, from a revenue perspective, and so we should see some good growth for the company in FY23.
Oh, thanks. That's all we have time for there, Mike. You've got a good institutional supporting there in terms of the shareholder register. Congratulations. We'll follow with interest and get you back on towards the end of the year.
Thank you very much. Have a great day.
Thank you. Next up, we have Neometals, ASX code NMT, market cap of 795 million. The stock's up a lazy 81%. We have with us Chris Reed, who is the Managing Director. Neometals innovatively develops opportunities in minerals and advanced materials essential for a sustainable future. Thanks for your time, Chris. Over to you. Welcome back. Just waiting for Chris. Seem to have lost Chris. We might move on, David, if we can here, just from the technical background. Just waiting on Chris, but Matt, I wonder whether you're available.
Yep, I'm good.
Okay, great. We'll jump ahead. Let me just do the intro if you don't mind, Matt. Next up, we'll have XPON Technologies, ASX code XPN, market cap around $50 million. Chris, we've just jumped into XPON, if you don't mind. We'll come back to you. Oh, we're going to go back with Chris now. Chris, I'll hand over to you. Thanks for your time. We're just getting the right presentation up, Chris. We were waiting for you. It's a bit messy today. We'll make a start when we get your presentation up. We good to go, team? We'll just wait for this presentation. I'm sure they're busy in the background. Hey, while I've got you, Chris, Benchmark Minerals put out a report today on what's going on in the recycling industry. We'll talk about that at the end of your presentation. Over to you.
Sure. Thank you very much there, Tim. Don't worry, it's not the first time. We often have technical difficulties over here. So good morning, everyone. It gives me great pleasure to tell you about Neometals and our greener battery materials business. Next slide, please. We are listed on the Australian Stock Exchange and the AIM Exchange in London, so always consult a licensed investment advisor. Next slide, please. So Neometals, we're actually producing sustainable battery materials right now from our operation in Germany. My presentation today will pretty much focus on the lithium-ion battery recycling business, although we have other businesses that we're developing in terms of recovering vanadium from high-grade steel slags up in Scandinavia and lithium chemicals, where we're starting that in Europe. So all of our technologies are backed by, all of our businesses are backed by technologies that we developed, and really we're commercializing with very, very large partners. They're very, very green. I'd challenge anyone to try to get higher grade, lower cost, greener battery materials than us. And those processes that we have developed really embody our commitment to general ESG principles, you know, well before ESG was even thought of. I mean, we started developing our lithium technology in 2012. We went into battery recycling in 2016 when people thought we were crazy. We're now leaders of the pack, which is fantastic. So as we're commercializing these overseas with big multi-billion-dollar companies, our focus returns in Australia to the continual improvement of those technologies and commercializing them. We've got a strong growing team of professionals, about 40 of us now. We've got a good track record of making money and returning that back to the shareholders. You know, we've returned more than $80 million in cash dividends, buybacks, and in-specie distributions. You know, our last return was demerging our nickel business, which is Widgie Nickel. That was a $26 million return for the shareholders. And, you know, if you'd been a Neometals shareholder over the last 7 years, your annual TSR would have been 70%. So it's been good days. Next slide, please. So our portfolio, we've only got one asset, a titanium asset left in Australia. Everything else is based in Europe. So we've got a 10-ton-a-day lithium battery recycling operation in Hilkenbach, Germany. We're working with Mercedes-Benz to start building them their own lithium battery recycling plant at Kuppenheim. The vanadium recovery is up in Pori, Finland, which is close to where the steel slags are being made. We're looking to put a battery recycling plant into Canada with Steel Company of Canada, and looking to commercialize our lithium technology with Portugal's largest chemical company in Estoril, Portugal. Next slide, please. An experienced and growing team. I won't go through everyone because I've been warned we've only got 10 minutes. Next one, please. Corporate dashboard, market cap of about $800 million. We've got about $90 million in cash and investments, no debt. The board, founders and management are the largest shareholders in the business, so we're very, very well aligned to making a real fist of it. We've made lots of money and shared it back with our shareholders. Next one, please. So recycling, we own 100% of it. The technology, SMS will soon earn 50%. Our partner SMS is a 150-year-old German plant builder based in Hilkenbach, Germany. They've got 14,500 employees in 95 sites around the world. They've got construction facilities on 4 continents. And we're developing that technology in a German incorporated joint venture called Primobius. Next slide, please. So, you know, we all know that there's going to be more EVs. They're building all the gigafactories around the world. I think Benchmark monitor about 300 gigafactories that are in the stages of getting built. Essentially, when they start making these cells, about 10% at steady state comes out as production scrap. In the early years, it's very, very high. It took Panasonic 5 years to get the scrap rate at the Tesla's gigafactory down below 20%. So what we've designed is a 50-ton a day operation, or 20,000 tons per annum, to take the off-spec as they make the cells. And then we will have a larger 500-ton a day plan, or 200,000 tons per annum in the future, to take the end-of-life vehicles as they come back. And, you know, each gigafactory really needs that much capacity. So on the right-hand side there, what you're seeing is the available pool for the global recyclers, initially production scrap. But what we're finding at our operation in Germany is that the end-of-life warranty returns and returns from accidents are actually the majority of the feed that we're experiencing now. Next slide, please. So what we've done is essentially create a base metal refinery to get all of these stuff not out of an ore concentrate, out of the ground, but actually out of the battery. So, you know, to put it in something that most mining people can understand, it's the same as having a ton of ore in front of a plant that's got 15% nickel, 15% copper, 2% cobalt, and 2% lithium. It is incredibly valuable. So we developed a hydromet rather than a smelting refinery to produce cobalt sulfate, nickel sulfate, lithium sulfate that we can make into carbonate or hydroxide, and then copper and aluminium foils. Next slide, please. So we created this safe, sustainable process. If anyone doubts how sustainable it is, we made it into the finals of the German National Sustainability Award in 2022. We were gutted not to win, but very honoured to have been nominated. These electric cars, you know, they have twice the carbon footprint of an internal combustion engine. That's because of the batteries and because of all the feedstocks that go into the batteries. Come from exotic locations like South America, Australia, the Congo, Indonesia, you know, but end up primarily into Korea, Japan, Europe, North America, in the form of cells that have largely been made in China. So to reduce the carbon footprint, the pyrometallurgical or smelters that do some recycling, they incinerate a lot of the product and lose it, but that sort of cuts half the carbon out. We're looking to strip out more than 95% of the carbon out of new batteries. Next slide, please. So what do? So the plant that you can see there on the right-hand side, that's the stage 1 shredding spoke, where we take the cells after they've been discharged and dismantled, a lot of the modules, so you can get individual cells or modules that come out of the cars. And we're actually finding about 70% of our feed is modules. So we have to discharge and dismantle them. We then shred them, separate the plastics, the casings, and the metal foils. And then we put what's called a black mass, looks like pepper. And that's a ground up graphite and cathode materials of lithium, nickel, cobalt, and manganese. We then put them into sulfuric acid. We use solvent extraction and ion exchange to then drop them out as a high purity material for reuse in new batteries. Next one, please. And there's a strong rationale for having them both integrated, the both parts of the circuit. If you just do the spoke only, which you can do, and assuming a 50% payability, it's not a bad business making black mass and just selling it into the pyrometallurgical guys, but really to close the loop and to address, you know, the circular economy and the requirement to produce recycled materials in new batteries, which is coming into effect in Europe from 2025 onwards. You know, you really do need to put the refinery hub there, and you know, to show you how cost effective our process is, if I take the total site costs and only take out the cobalt credit and divide that amongst the nickel tons that we produce, we're the new lowest cost nickel sulfate producer in the world. So then the goal is just get bigger. Next slide, please. So flexible business models. At the moment, we're running an operation where we're actually charging and receiving between 1,500 and 1,650 euros per tonne to process the batteries, which is great. We keep the black mass and sell it. So we're making cash at the moment. We've also got partnerships. So to get bigger, we're prepared to actually share the economics with those that have got batteries. So the cell makers and car makers. And I'll shortly run through examples of how we've got partnerships and licenses. Next slide, please. So in Europe and North America, they are the key markets for us. We can't really justify going into China at this juncture. And look, Europe and North America are growing very, very quickly. If we have a look at Europe, you know, the total addressable market in 2026 will be about 250,000 tonnes. The total installed capacity at the moment would be about 100,000 tonnes. So, you know, there's a lot of capacity that needs to be added, and we plan to be a very, very large part of that solution. And then, of course, later in the decade, it just gets bigger. So we're one of the only urban miners in the world with an ore body that keeps growing every day as these lithium batteries wear out and they make production scrap. Next slide, please. So our commercial pipeline, we've got a spoke that we're operating ourselves. We're looking to put the 10-tonne integrated plant, that's plant supply and licensing for Mercedes-Benz. Steel Company of Canada, looking at putting our first integrated 50-tonne. We'll shortly announce the results of our own study to put one into Germany. And we've got an MOU to put one into Japan. Next slide, please. Now, this is a video that Mercedes-Benz put out when they announced our selection as a technology partner. It was a very grueling 16-month process, global. So I'm pleased to say an Australian generated technology was picked. Very honoured to be working with Mercedes-Benz. Like I said, we've entered into a 5-year collaboration, plant supply, licensing, and then we have people embedded and teach them essentially how to use the technology. Royalty free for the first 10 tonnes per day, but you know, that's our plant there. That's their cells going through our plant. That's some of the foils that we get off that I mentioned. That's the black mass in the leach, and that's our solvent extraction circuits, pulling out very, very nice coloured materials that we get paid handsomely for. So yeah, really, really looking forward to closing the loop for Mercedes. Next slide, please. So that's just a bit of a summary. Now this one is Stelco. So Steel Company of Canada, big steel producer going into the automotive industry. They want to transition from blast furnaces to greener steel, and that's achieved through using hydroelectricity in electric arc furnaces. That means less iron ore and less coking coal and more electricity and more steel scrap. So to get the steel scrap, they need more end-of-life cars. More cars are going to have batteries attached to them. So what we've done is we've licensed Steel Company of Canada on a 10% gross revenue royalty in the interim to allow them to secure feedstocks. Once we offer them the plant, we've then got an option to buy into 50% of that by refunding half the sunk costs. So it's a fantastic deal. For both Mercedes and Stelco, we are looking at supply contracts at the end of the year. Next slide, please. Timeline, like I said, engineering cost study out this month. The engineering cost study for the Hydromet hub in December, the spoke plant for Mercedes-Benz and Stelco in December, and a decision to go to buy into the Stelco recycling joint venture in Japan. Next slide, please. Sustainability, well, we're not greenwashing everything. All of our technologies are green from the very day they were invented. We're putting out our third sustainability report. Next one, please. And so we've got a fantastic portfolio of ESG aligned materials. We're producing 5 out of the 6 most positively impacted commodities as forecast by the World Bank in 2050. Proprietary technologies, great strategy, strong balance sheet, great team, good track record of making money. I think we've got a fantastic organic growth profile. So thank you very much for listening to me today on Share Cafe. And Tim, no doubt you got a question or two.
Yeah, thanks, Chris. A fascinating, successful story. Congratulations. There was a benchmark minerals report that just came out, or it was a brief report that came out just prior to today or prior to the webinar. And it's talking about how China dominates the recycling market. The top 8 recyclers are operating from that country. Is there a kind of a political push, a geopolitical push for recycling to be treated as importantly as in the supply chain argument for EV batteries? There's this political push to own the chain, the supply chain. Where does recycling sit?
Yeah, so look, if I take Europe as case, so Europe is the largest importer of cells, predominantly from China or, Asia. So they have got some cell making capacity. Europe and America clearly behind China and Asia, but catching up. So recycling will play a large part of trying to secure the feedstocks for future battery production. So, recycling is mandatory. They're increasing the recovery rates that you need to do. They are having minimum recycled content in 2030 and 2035 of 10% and 20%. So, they're more expensive cars, obviously, that are made in Europe. And so, they can import the cells. They just don't want them leaving. So they really want to create a fortress around each of those markets. And the Chinese recyclers, yes, because, 80% of the world's lithium batteries are made in China. So it then follows that the production scrap has generated, 8 of the top 10 recycling companies in China, but they're really doing production scrap. And to what we can work out, they're not really going overseas. And because their market's so big, there's no need to. Whereas, who should be a natural owner for our technology? Should be the car makers, right? Because there's probably not going to be enough for every car maker in the world to secure their feedstocks, right? And so, JB Straubel, the Tesla CTO, left and set up Redwood Materials, and Redwood are putting recycling plants wherever there's a Tesla gigafactory. We're tied in with Mercedes-Benz. Some of the other car makers have tied in with one of our competitors, Lysical, in the US. So yeah, it's a real issue to try to reduce your supply risk going forward. And circular economy, if you're really trying to take the carbon out, then yes, you do need to recycle. And a lot of these guys are in the Dow Jones Sustainability Index, where you've got to recycle 85% of your car. And whilst the EV fleet's a very small percentage of the total fleet at the moment, as that grows, they really do need to have their own solutions. And there's basically not many of us, only because we started 6 years ago.
And your focus is on Europe. Where does North America sit in terms of your development?
North America will be our biggest plant at this stage. So, we've got a 10-ton plant in Germany. We're looking to supply Mercedes a 10-ton integrated plant with a refinery. The 50-ton plant is initially going to go at Stelco's Hamilton, former Hamilton Steel Works. They're not producing steel there anymore. It's a fantastic site just outside of Toronto, located at the top end of Auto Alley, and they're suppliers into the US car making industry. So, for them to it's a logical step for them to expand into whole of car recycling and then pass the batteries over to us in a joint venture to handle the recycling.
And there's just some, excuse me, and there's some questions here around your Promobius. Yeah. Promobius, the recycling plant, when's that kind of come online? There's been some delays. Is there any more colour on that, please?
So look, the 10-ton plants, we're just in the ramp-up phase. In terms of the engineering cost study on the 50-ton plant for Germany, yes, that's running a little bit late, but that's only because we've exceeded our expectations and we've inked a couple of commercial contracts. So we're more focused on doing everything to deliver Mercedes-Benz and Stelco actual plant supply agreements in December than we are in finishing evaluation or feasibility studies for future plants. So our commercial success has exceeded our evaluation timeline.
There's a technical question here. Did the company receive the federal emission permit from German authorities to enable the shredding plant operations at a maximum battery input rate of 10 tonnes per day?
That is correct. We have an emissions license, what's called a BIMSCH. That's the short version, and I couldn't possibly pronounce the full German version.
Okay, Chris, that's all we have time for. It's a fascinating story. Congratulations, as I said, and we'll follow with interest.
Thank you very much. Have a great day, everyone.
Thanks for your time. Okay, we'll now get back XPON Technologies, ASX code XPN, market cap around $50 million. It's only been listed in the last 12 months. We have with us Matt Forman, who's the founder and group managing director. The company is a technology company focused on the next generation of marketing and customer experience. Matt, apologies for the mess before, but over to you. Thank you.
All good, thanks Tim, and good afternoon everybody. Very excited to share with you all the XPON story today. If we just go through, thanks to the next one again. So XPON, I'll go for the next one again. So XPON's essentially a marketing technology and cloud company. And to put in the simplest terms around what we do is we help our customers make sense of their customer data, and then we use that to help them unlock exponential growth. And there's a lot of really big macro drivers that are really driving demand and providing some very strong tailwinds for us. We go to the next slide, please. And there's 4 of these different trends that are converging at once. So first of all, you've got this mega trend around data security and privacy. And we all know as consumers how much more aware we are of how information is being used online. And I guess that consumer awareness is also being matched by the regulators all over the world. Also, the technology vendors, the main internet technology vendors, so the Googles, the Apples, the Microsofts of the world, they're actually removing technology called third-party cookies. And those third-party cookies is technology that's used to actually track what consumers do online. So you've got this trend where governments are making it more rigorous around privacy, and you've got the technology vendors removing the ability to track information through third parties. You've also got this trend from consumers who are really more interested in these really personalized experiences. And there's a bit of a balancing act there because, excuse me, the balancing act really is you don't want to be creepy, you don't want companies to know too much about you, but you still want a really personalized and relevant experience. And then finally, you've got this sort of increasing trend around extended reality in the metaverse. And we feel XPON's really well positioned around that. With our Holoscribe platform to take advantage of that trend as that starts to come through in the coming years. So we're really well positioned in the convergence of these 4 trends to take advantage of that and really continue to grow at the pace that we've been growing. Next slide, please. So how we're structured around that, we have an XPON Technologies business unit, and that's our business that really helps our customers implement these technologies. We're also a partner with Google, and we resell some of Google's technologies. So that's a great channel for us because Google provide us with leads that we can then bundle and package our technology with. And our 2 technology platforms are Wondrous, which is a customer data platform. And essentially what Wondrous does is it takes all the information that our customers or our business clients have about their customers and consumers. It centralizes that in a really privacy compliant way. It uses machine learning and AI to then enrich that data and add value to that data. And it does that with things like machine learning predictions. So it can predict behaviors of customers, which customers might have a propensity to churn, which customers might have a propensity to buy more, which customers have a high predicted lifetime value. And then once that machine learning and AI has done those predictions, those insights then are available to activate directly back out into the internet ecosystem. So we have native integrations with platforms like Google and Facebook, LinkedIn, Shopify, HubSpot. There's lots of different integrations that we have. So our customers take this really rich machine learning powered data, use that then to synchronize back out in a very privacy compliant, anonymized way, and then can get much more effective marketing outcomes. And that could be things through things like digital advertising, or it could be things like better customer experience as well. And I've got a case study that I'll talk to in a second to explain that in a little bit more detail. And then just quickly there on our Holoscribe platform, that's essentially a bet on the future for us. We've got some great traction with that already. We got into that extended reality space quite early. And we've got some very good customers that are using that to build out these really rich immersive experiences. And how we differentiate with that product is it's the only extended reality platform that's natively integrated into a data platform like Wondrous. So we can actually use all that really rich data that's in our data platform in Wondrous to power these very unique and personalized experiences in this new immersive world as well. Next slide, please. So just to sort of paint a bit of a picture of where we sit in the industry value chain, the way I like to think about this diagram is each of those different sort of circles along those different lines are like subway stations or train stops. And how XPON works, and particularly our Wondrous customer data platform, it allows us to actually grab data from all these different sources that a customer might have on their customers and consumers. And that could be things like their CRM or their point of sale or their loyalty systems. There's lots and lots of different systems. Most big companies have up to 200 sources of information. Typically with our customers, we find they have between 6 to 8 primary sources of information. And then we can pick which train stop or what part of the journey that we start a relationship with our customer. And that's really a key part of our land strategy for the business model, is our customers don't need to buy everything. We can fit our technology into their existing tech stack. It's not a suite like some of the big vendors have where you need to buy everything to get the full value. And so to give you a working example, let's pick digital advertising as a use case. One of our customers may have a need to get better return on investment from their digital advertising. They want to use their data to make that return more effective. We can start working on that with them. We can prove value very quickly. We can demonstrate ROI, and then we can incrementally deploy across all those different parts of the industry value chain. So we unlock all these data silos so the entire organization can benefit from it. And it's not just marketing teams, that works across the entire organization. So primarily our key buyers are CMOs, but we also sell into CTOs and CIOs, chief digital officers and chief data officers as well. Go to the next slide, please. So I'm often asked what the strategy is for XPON. I think this diagram does a really good job of explaining that really simply. Because of those convergence of those trends, they are creating some really strong tailwinds for us. And that really is a once in a generation opportunity to land customers. And as I've explained, we land them typically with a single use case and solve a single problem. And then between our technology and our strategic capabilities, we then expand across all those different stops on the subway station map that I showed you before. Now we have very, very strong unit economics, and we'll talk to that in a second, which means we're very profitable at the underlying customer level. Now we're still investing heavily in growth at the moment, so the company level we're not profitable yet, but those strong unit economics is really what's creating the operating leverage for us to get into profitability and into cash flow break even. And we're targeting to be cash flow break even next financial year for the full year. Next slide, please. This is just a quick case study of the University of the Sunshine Coast. They're a good example of a customer where we're working across multiple parts of our solution and our technology stack with them. So this uni, COVID hit 3 years ago. Obviously, they couldn't do on-site open days. They adopted our Holoscribe platform quite early in the piece. So we built out their first virtual open day in a really immersive environment on Holoscribe. We also implemented our Wondrous platform in that first year. And the main purpose of that was essentially to collect all this really rich data that was being generated through that Holoscribe experience. And so that university was able to use that experience to capture all this data, things like were the people going there students or parents or mature age students or school leavers, what their study areas of interest were business or marketing or whatever. So all that data streamed directly into our data platform. Now we're into the third year. I think they launched this about 2 weeks ago, this year's open day experience. So all that data they've been collecting over the previous years is now being used to make the experiences even better and even more richer and even more valuable to that customer. So you can see one of the call out metrics there around this is the engagement rate. And in this example, it's the average pages per session. So it's 3.7 times more effective than any of the other digital content they have on their website talking about open day as well. So there's a link on the slide there. So if you do want to have a look at it, you can follow that link and check it out. Go to the next one, please. And this is just another case study. This again is talking specifically to a Holoscribe platform. Amnesty International has been a great customer of ours for a number of years. Their team used the platform to get information out very, very quickly about some of the atrocities that are happening in the Ukraine. So their team on the ground were able to capture this really rich 360 immersive content and in a matter of days get that up and get that circulated all over the world so people could go and actually see in a really immersive environment just what was happening on the ground there. Next slide, please. So just some key highlights. So this is our FY22 financial results that we released recently. So we've had very strong growth across all our metrics. Revenue, annualized recurring revenue, I should say, up 78% year on year to 16.4 million. Our revenue was up 145% to 13.1, gross profit up 169%, and our gross margin continues to expand up 6 percentage points on the previous year. And probably the other key highlight on that is 93% of our revenue is recurring. So we've got very, very strong annuity revenue streams. which gives us a lot of confidence in being able to invest into the future and predictability into what's coming next. Next slide, please. This is just a view of the half-yearly results over the last few years. You can see there with revenue, gross profit, and gross margin. And again, that land and expand sales motion that we have, you can see that really paying dividends as the gross profit and the revenue continue to increase exponentially half on half. And again, our gross margin continues to expand as we can consistently executing as we go. We've got a target to get that gross profit margin in the 70 to 80% range. Currently, it was at the end of last half, 65%. And we're very confident we'll be able to do that over the coming periods. Next slide, please. And just to provide a little bit more color on the revenue and how that's made up. So the stack chart there on the left, that's the 4 different streams of revenue that we segment by, that we disclose. So the usage fees, so that's fees, consumption-based pricing that we have, fees that are generated for how our customers are using technology or how they're spending money on advertising. Because of our partnership we have with Google, we're in a very good position that we get a clip of the ticket for every dollar that they're spending on advertising that runs through the platforms. And that's at 100% gross margin to us. So it's still a small part of our revenue mix, but a growing part and a very high margin part. And then the other components are our project services, which are one-off onboarding and implementation fees, which is very low, 7%. And then there's a mix of the software licenses and what we call managed service subscriptions. So one of the things that we do quite differently is when we sell a software license, we'll attach a managed service subscription to it, which enables us to stay very close to the customer and make sure they're getting success out of the technology on an ongoing basis. And just a bit of mix on the revenue mix by geography. So Australia is still the majority of our revenue. The UK is just shy of 40% of our revenue. That mix is shifting. You can see there it shifted 5% year on year compared to the previous year. We do expect the UK to continue to grow. Australia is still growing very quickly as well, but we do expect that the UK will be a bigger contributor to our total revenue pie over the coming years as well. Next slide, please. Here's just a bit of a waterfall view of our annualized recurring revenue growth. So you can see each quarter, we're just consistently adding new recurring revenue. That grew 78% year on year. We exited June at 16.4. Next slide, please. So the unit economics, and this is something I'm really proud about. The team does a very, very good job of executing because a lot of these metrics are absolutely world-class. So we don't churn very many customers at all. It's very sticky. What we do, we have a 99.5% customer retention rate. Not only do we keep our customers, but because of that land and expand sales motion and that approach that we take of going on a journey with a customer and being able to grow incrementally, we're able to continue to expand our revenue retention rates 160%. Our lifetime value for customers currently at 667K. It costs us 43K to acquire a customer. So we get that paid back in 8 months. We're happy if that continues to increase up to 12 months. We don't want it to go over 12 months. So we think we've got plenty of headroom to continue to invest in landing customers because they become so profitable for us over time as they continue to expand. And our lifetime value to CAC ratio is 16 times as well. And as at 30th of June, the 136 million total customer lifetime value. Next slide, please. And just a bit of a snapshot of, I guess, how we've executed on that land and expand strategy. Excuse me. So we landed 32 new customers for the year and we expanded 34 customers. And you can see the logos on the screen there. These are well-known established corporate and enterprise customers. Not only do these customers have a serious problem with what we're solving for them, but they're at the sort of scale where we can actually have a meaningful impact and actually create high returns on investment. So it means that as we grow alongside our customers, our revenues are continuing to grow over time. So from a size of customer, some of our smaller customers in that corporate enterprise space are worth in the sort of 50 to 60K a year. And some of the bigger ones are up towards 800 to 900K a year. Next slide, please. Just very quickly, we listed last year on the ASX in December. That's given us the capital to invest really heavily into the growth infrastructure. Predominantly, that's been people. We've grown our team to 135. The other thing that's been really great about the business is as we've grown, we've been able to really keep very good high customer satisfaction. a net promoter score through the years greater than 80%. I think the last quarter at the end of June, it was 88%. Next slide, please. Next slide. And then finally, just to talk across the growth pillars really quickly, these are the areas that we're focused on, really strengthening our existing solutions. That may include acquisitions. There's nothing on the cards right now. It's not a focus for us yet. We really want to continue to invest in the value of our products and make sure our customers are getting value from that functionality quickly. We've invested heavily in our sales and marketing capacity and now extracting the value out of that. We've got great relationships with Google as a channel partner. We've got nascent relationships with other global tech vendors as well, and we'll hopefully be able to announce some things a bit more certain in the future on that. And the final piece there is continue to build out that ecosystem for our Wondrous platform, so it just becomes a component of a much broader global marketing technology ecosystem. And I think one more slide and then that's it. So yeah, so just to wrap up, the focus for us is we want to maintain that really strong organic growth momentum that we've got, and we want to target on being cash flow break even by FY24. We want to do that sensibly. We don't want to choke off our growth, but we also want to be quite efficient with our capital. We're obviously going to continue to invest in our product, continue to invest in our people, ensuring that land and expand sales motion continues to drive results, particularly with revenue retention as we continue to grow those customers over time. And finally, they keep investing in the product ecosystem and our channel partners. So that's the focus for XPON. So thank you. I'm sure there's some questions, Tim.
There is some questions. Thank you, Matt. Just on that third-party cookies, I mean, we've seen on every website at the moment, and you've spoken about how that kind of plays into your hands in regards to first-party data. So how does that actually work? How does that play into your hands, and how does that work with your relationship with Google, for example?
Yeah, absolutely. So just really quickly, a third-party cookie is a really simple bit of technology. It's essentially a text file that lives in your browser, in your internet browser. As what it was able to do is track where you go on the internet. So every website and every page got written to that file, and then third parties, whoever they might be, could read that and get that data about you. And I guess that's how Facebook got so big, selling ads and knows everything about us, because they've exploited that technology. As the vendors have stopped that, you may have seen a lot of talk about this, particularly with Apple. Apple, when they blocked that, Facebook have said it's going to cost them $10 billion in the first year in lost revenue. So it's a massive problem. So what our platform does is it allows our customers to use data they already have about their customers. So that could be their purchasing history, their browsing history on their own website. There's lots of CRM data, there's lots of different sources, anonymize it, and then send that back out to Google, Facebook, or whoever it might be, and then use that data to target advertising against. So it enables, I guess, this ability for that third-party data that's decaying and going away to be replaced with more valuable and relevant data, which is first-party data. And in fact, the results we see from our customers around the effectiveness of their marketing when they use first-party data, it's very, very strong. We're about to release a case study shortly, but it's in the high 70-80% improvement rate on the effectiveness.
Yeah, it'd be fascinating to look through and talk through a real example. I think it'd help explain that moving forward. Now, there's just a question here on your revenue growth. You've had strong revenue growth of 145%, I think, in the financial year 2022, but you've got an increase in costs in regards to your operating expenses. Can you talk through what has driven that sort of increase?
In the cost or the revenue?
Yeah, the costs.
Yeah. So predominantly investment in people. Like when we listed in December, like a large part of the use of funds from the IPO was building out sales and marketing capacity, and also delivery capacity around that as well. So the last 2 quarters, we've had some fairly heavy lifting with our recruitment. This quarter that we're in now will be the last quarter of heavy recruitment. We'll see that stabilize. I think we've disclosed previously that we think this financial year will sort of cap the year at 160 headcount. And at the end of June, we're at 135. So as I said, most of the heavy lifting's been done on that now. And now it's about extracting the value from it and generating that operating leverage to get to scale.
I mean, there's some fantastic margins in your business. Can you talk through that cost of acquisition? That seems like a big number, even though the contract values are quite high.
Yeah, so it is an enterprise sales cycle. So there is a lot of inputs into that. So the way that we calculate the CAC, it's all of our marketing expenses. So that's things like advertising, events, trade shows, those sort of things. A large portion of the salaries of our sales team, I think it's 80% off the top of my head of the sales team salary gets put into that, plus any sales commissions they get paid. So you do get a really transparent, true view of what it actually costs the business holistically to acquire those customers. Probably the other thing to note too, on our lifetime value, which was 667K, that's gross margin. That's not total, it's gross margin. So, you know, that gap between 667 and 48K, that's in gross margin dollars, not in total revenue dollars as well.
And obviously, Australia is a big part of your revenue, and the UK. Where's the US sitting in this equation? And is there anyone in that market that you consider a competitive? Is that a step too far?
Yeah, look, for now, we're not focused on North America. There is some very big global competitors. So particularly with our Wondrous technology, we do go up against the big suite vendors, so Salesforces, Adobes, Oracles of the world. I think our competitive advantage over that is that we're a niche player that can plug into an existing technology stack. You don't need to buy everything to get value from it. We can make the technology they've got work even better. And our platform is what we call a no-code platform. So you don't need any technology skills or data science or programming skills to use it, whereas a lot of these other vendors have, you need to be quite technical to get the value out of it. So we're focused on UK and then broader Europe. We do have some customers outside of the UK and in Europe, and we will continue to expand there as well. And Australia and New Zealand for now is the focus.
Okay, Matt, that's all we have time for. Have a nice weekend. Great to hear the XPON story.
Thanks, Tim.
Thanks, everyone. Thanks for your time. Have a great weekend. I think the sun's coming out somewhere. Enjoy it, and we'll be back next week.